Market volatility continues to build. And our next guest, though, sees volatility as an opportunity. For more on this, we're joined now by Grant White, portfolio manager and investment advisor at Endeavor Wealth Management. And Grant, thanks very much for joining us.
Hey, thanks for having me.
This is a perfect day, I think, to have the conversation. Another volatile day on the markets. How are you treating this right now?
Well, I think, as you pointed out, I think volatility is an incredible opportunity always in markets. But, one of the things I really like about the markets today is that we're seeing a movement back towards quality versus just momentum of a story. And so I think that's really great for disciplined investors who are going to stick to their philosophy, because I think there's going to be lots of great opportunities for growth over the next year or two here. But I think that's also dangerous for the undisciplined investor who's going to be chasing returns on something that's done very well over the last few years, in particular some AI stocks. And so it's not that I don't think the AI story is going to do well. I think it is going to do very well, but I think that you're going to have to pick on fundamentals instead of just chasing momentum at this point.
It sounds like people with AI are taking a little bit of, okay, time to show me now. When you talk about the quality, where are you looking to find that quality?
Well, I think you got to be careful on the spend, first of all. I think balance sheets and cash flow are going to be, they're back in the forefront of what's important again going forward. And especially if you look at the companies that have struggled more recently, like the software companies, I think the talk of their demise is well overdone. I think there's going to be some really great software companies that are going to do very, very well out of this. But I do think that a lot of them are still going to be challenged at the same time. And so margins are compressing. And so you're going to have to go towards quality. Now, companies like a Salesforce, for example, I think can do very, very well in this environment, but you're going to focus more on fundamentals, like where's the cash flow? What is it going to look like going forward? Is margin going to be compressed? And are we getting a repricing on some of these companies? And I think that is what is going on here, is they're just being repriced. But so I think you got to go back to the fundamentals is the key message I'd like to get across here, because I think that's that much more important today and going forward than it has been in the last few years.
And how does AI change are the fundamentals changing because of AI, or are the fundamentals still the fundamentals?
I'd say largely the fundamentals are still the fundamentals. However, the companies that adopt AI well, obviously, are going to do, I think, very, very well in this. Because, some of the numbers are going to change. The efficiencies are going to change. Operational efficiencies, in particular, are going to change. And so the companies that adapt well to that, I think, can do very, very well. In the case of software, the companies that are open to, plugging into other systems, because I think the holy grail of all of this is going to be how connectivity works between different systems. If they're trying to run a siloed version of AI that doesn't connect well with anything else that somebody's doing, I think they're going to be challenged on that. But the companies that open the doors, allow for integration across systems and across other platforms, I think that's going to be they're going to do very, very well. And so the fundamentals may change a little bit from that perspective in terms of philosophy, but the numbers are going to be the numbers at the end of the day.
And are there sectors that are embracing AI more than others, and maybe sectors that might surprise people?
Well, I think the sectors that are going to do very well. I think we're seeing this in the energy sector, for example, but I think we're seeing it in a lot of industrials that, people probably are the lesser known story of this whole thing. And so yeah, we're seeing it there. We're seeing efficiencies start to develop there. Biomed and companies like that, I think are going to do very well also. I think we're at a point where the breakthroughs are going to be extreme, and they're going to be great, and they're going to be quick. And so I think that there are certain sectors that are going to do very, very well, and including Biomed and others. But I think you just got to be open that there's going to be certain sectors that probably are the lesser known in this story that are going to do very, very well.
Okay, and let's get to some of the stocks you're liking right now. First up, out of New York, Medtronic, MDT.
Yeah, so Medtronic actually just came out and reported, and it was an okay report. Medtronic is a fantastic business, by the way. They're run very, very well. They produce a lot of great, technology for hospitals, including robots for over different things like insulin pumps and such like that. So they're a very good company. They've got a strong product lineup. They're going to do very, very well. The report was okay. The guidance looked okay as well. I think that what we're seeing is there's going to be a little bit slower growth going forward than what we've seen in the past from Medtronic. And so we've got the company as a whole today. But, if you are owning this company, I think you're going to continue to do very well on it. We're just not buying it today at these prices.
All right. Next up, Celanese, I guess is how you pronounce it, CE.
Celanese, yeah, this is a great company as well. I mean, and what they are is a chemical producer, a specialized chemical producer. I think you're like the opposite of Medtronic here. You're getting this company at a fantastic pricing right now because they're, not on their cycle, essentially. I mean, the industrial cycle is not working in their favor. And so you're getting a really great price. But this company produces chemicals for things like automotive part production and things like that. And I think that, going forward, they're going to do very, very well when the cycle kicks in. They're also deleveraging right now. Management's done a fantastic job post acquisition a few years ago, and they're really cleaning off their balance sheet here. And so I think that what you're going to see is some really great profits going forward in this company, especially as the cycle kicks back in their favor. So this one is an absolute buy right now. They're priced well, and I think you're going to do very well.
Okay, we're almost out of time, but let's get Fairfax in a classic. What do you like about it?
What I love about Fairfax, we've owned it for a long time, and I think this is a really great time to, if you're going to do a flight to quality, Fairfax is of the highest quality, great business, great money allocators, cash allocators. They've done a fantastic job over the last few years of cash flow growth on a quarter-by-quarter basis. And so a long story short on this is if you're not trying to chase a cycle, I'd be looking at Fairfax because they're going to weather storms very well in terms of volatility, and the pricing is very good right now too.
Okay, we'll wrap it up there. Grant, thanks as always for joining us.
Thank you so much.